All right, guys. So we are here with Jonny Price from Wefunder. He's the director of fundraising, and we are going to talk about money. In this case, we're going to talk about crowdfunding, equity or debt, capital investments into your business. So, Jonny, hello, welcome.
Hello, thanks for having me.
Thanks for being here. So Jonny, we've talked, that's not good English. We've spoken a couple of times, and you are incredibly passionate about what you do, which I really love. Can you tell us what Wefunder is? Give us the spiel that you're so good at.
Yeah, so Wefunder is an investment crowdfunding platform. So it's a little bit like Kickstarter, but on Kickstarter, people are buying like perks or a product at a discount. With Wefunder, they are investing in your company. So as you mentioned, as a small business owner or a startup founder, you can raise either equity capital, which is by far more common on Wefunder. About 85–90% of our capital is raised through equity on the platform, or you can raise through debt, so you can borrow money and then pay investors back with an interest rate. But if you're trying to raise capital to launch or grow your business, then Wefunder is a pretty new option that you should consider.
Awesome. And so, interestingly, you'll have lots of opinions on this. I think for a long time, it's been assumed, or it's just been true, that, small businesses don't raise equity, right? They sort of, go get a loan, oftentimes at a very high interest rate, and they try to pay it back, or they take out a mortgage on their house. And I know that you guys have talked a lot about sort of democratizing raising equity. So when I talk to small businesses, there's usually a lot of confusion around, what does that mean? And does it actually work for a small business? Or is that something that, tech startups do or big companies do? So how should a small business think about, if this is the right option for them? And maybe, well, let's start with that. How do you know if it's the right option for you?
Yeah, that's a good question. And to be honest, it's a very complicated and multifaceted question, and it's probably difficult to answer in a kind of short few minutes here. I think like every business is different, and also every entrepreneur is different. And so some folks, even for the same business, some people might be more attracted by raising debt capital versus equity capital. Certainly everything is technically possible, right? So then it's a question of what's best for you. And you also have to consider the investor side. So I think probably partly why you asked that question in that way, and why we kind of normally think of tech startups raising equity, is from an investor perspective. Like the thing with equity, like there's a huge upside. With this tech startup IPOs, then the early stage investors in Uber make like 10,000x returns, right? And those kind of returns aren't available to a coffee shop. Like if you're an equity investor in a coffee shop, like it's not going to go 10,000x. And so the upside is not there. And so the high risk of equity investments doesn't have the corresponding upside for investors. And therefore, like investors might be less likely to invest in equity deals in a main street business that doesn't have that holistic growth potential. So that's why I think, again, you asked the question in that way. But, there are some investors who might be quite interested in getting paid out in profit distributions or dividends over many, many years. Then the upside for them might be multiple times what they would invest in a loan. So their kind of return over the lifetime of the investment might be higher if they're investing in equity versus debt, but it takes them many, many years to pay back. But then they continue to own the asset of equity in that business. But so on both the investor side, where is there going to be demand from investors? How can you convince investors to part with their money and invest in the business? And also on your side, right? So if you're if you're an LLC, then bringing on additional members of the LLC, who then you have to deal with K1s every year. There's tax implications, there's business administration implications. There's like forevermore now you have to pay like a percentage of your profit distributions. There's like kind of management and ownership kind of complications that entails. So in some senses, I mean, for a Main Street business owner, like debt is a simpler instrument. So on both sides, there's kind of pros and cons to equity versus debt investments. I certainly wouldn't rule it out. Yeah, sorry, I can't give kind of a neater or kind of easier answer than that. And by the way, you know, we have had Main Street businesses raise with equity on Wefunder. It's certainly more common for kind of small businesses as opposed to tech startups to raise with debt, but they certainly have raised with equity on Wefunder. And conversely, we now have a growing movement where tech startups are actually raising with debt capital. This is called a revenue share, where instead of giving up equity ownership of the company, tech startups are basically taking a loan and paying investors back on a multiple. It can seem like quite a high interest rate versus a bank loan with a 5% APR, but on the other hand, like, you're not giving up ownership in the company. And if you think about an equity investment in Uber as a loan, then that loan was paid back 10,000 times. So there are tech startups which are borrowing debt on Wefunder, as well as Main Street businesses that are raising capital through equity. It really is a bit of a kaleidoscope. But I mean, generally, to your point, you know, yes, Main Street businesses are tending to go the debt route. That tends to be better for them. It also tends to be where they can find investor demand, but there are exceptions.
Well, I think your answer is perfectly complicated, because one of the things that
frustratingly complicated, one of the two.
Yeah, no, I think it's just accurate. I think that, you know, for a long time, small business owners have thought that their options were really limited. And I think the options are opening up with, you know, the technology that people like you guys have launched, but it does become more complicated because choice essentially makes things more complicated, more possibility, but also more options, which means you've got to really understand those options. So we talk a lot about, go ahead, yeah.
And just to build on that, so like until May 2016, what we do at Wefunder, which is called regulation crowdfunding, which is a new exemption that the SEC rolled out as part of the 2012 Jobs Act, which allowed startups and private companies, small businesses in America to raise money from unaccredited investors and publicly promote the offering. Sorry, this is a lot of buzzwords, but like the point is, it's a new way to raise money through crowdfunding, investment capital through crowdfunding, that until 4 years ago was not legal. So what we do at Wefunder, investment crowdfunding in itself is a whole new option, right? And then like even crowdfunding is like relatively new, like Kickstarter wasn't around 20 years ago. But then within investment crowdfunding as well, you have equity or debt. On the equity side, you can do a price round where you're just giving straight equity, or you can do a convertible note, or you can do a safe note. We have companies like Hopsters is a brewery in Boston. They raised $1 million on Wefunder, and they had a deal where until investors got the $1 million back, their principal and the investment back, they were getting 80% of profit distributions. And then after they got paid back 1x, then that flipped to 20% of profit distributions thereafter. So there's, you know, even the kind of three that you hear, price round, convertible note, safe note on the equity side, you can come up with a weird and wonderful investment contract that's kind of increasingly generous to investors. Like there are kind of options within options. It is a complex picture. One of the things we do on Wefunder is to help small business owners think through their options or connect them to people that can help them think through the options, that, you know, depending on what's the best fit for them as a business and them as a founder.
Perfect. And I got like 5 things that I want to touch on for what you just said. So first of all, an accredited investor. So, you know, you and I use these terms interchangeably. Some people are watching and being like, what are these guys talking about? So if we were to just simplify it for them, equity means you're selling a portion of your company in exchange for investment. Debt means you're taking a loan and paying back the money plus interest, right? An accredited investor before the Jobs Act, like you touched on, if I remember correctly, an accredited investor needed to have a net worth of over $250,000. Was that right? Before they were legally able to make an investment into a company. Do I have that right?
It's a net worth of $1 million, excluding their house and or personal income of $200,000 for the last 2 years, or household income of more than $300,000 for the last 2 years. Basically, the long and short is it's like a very rich person.
Yep. Right. And so that inherently meant that, we were seeing this inequality where only rich people could make investments and only essentially the people who knew rich people could get investments. And so that's where you create these inequality bubbles that everyone is so very justly mad at, which is rich people keep getting richer in relationship with other rich people. And anyone who's not part of those rich circles, essentially, unless they were very savvy, were out of the equity game entirely. And so
exactly, which by the way is why our founders started Wefunder, because
so
they were entrepreneurs. They had friends who were starting companies. They wanted to invest in them, and they weren't able to because they weren't accredited. They weren't millionaires, and so they weren't able to invest in their friends. And they said, "This is really like annoying and un-American." And so, they lobbied Congress to change the law, and they did that with the 2012 Jobs Act. And that, to your point, you put it very beautifully, actually. But to your point, like now anyone can invest in private companies. Anyone has always been able to invest on the stock market, right? Anyone can go and like buy a share of Starbucks or Apple today. So these big companies could benefit from anyone investing in them. But the coffee shop down the street from you, until a few years ago, could only raise money from millionaires. And so exactly as you say, now we think it's really cool that firstly, anyone can invest now in their friend's company or in a company that they care about, in a sector that they know something about. So the gains from investing in private stage companies are no longer restricted to rich people. And then also, exactly as you say, right last year, 1% of venture capital went to Black founders. Speaking June 16th, 2020, like George Floyd was murdered a couple of weeks ago, and Black founders got 1% of venture capital last year. So if all the general partners at VC firms are white men and they're investing in white men, it seems like that's maybe related. So if at Wefunder, we can say like a woman of color in Cleveland or Baltimore can be an investor, an angel investor in startups and small businesses in her community, as well as the rich, the millionaires. Anyone can be an investor. Hopefully, to your point, that means we can also get more capital flowing to founders of color in the heartland of America, not just the coasts, and kind of level the playing field for founders and entrepreneurs as well.
Yeah, it's really exciting. I mean, one of the things I'm passionate about is, what it takes to create a just economy. And I think access is a massive part of it, right? And demystifying, when I talk to small businesses, again, their eyes sort of glaze over when we start talking about, different debt and equity options and how you could, build capital into your business, but we can't, for the small businesses who are listening, these are things we need to understand. And to your point, that doesn't mean we all need to go raise equity, but we need to understand what the options are to fund these small businesses. And because of the work that many people are doing, you guys included, the options are getting better, right? It's not true that if your bank denies your loan, you can never get capital and therefore your business can't grow. There are more and more options. And so understanding them, I think, is really important. And that's really the heart of this series, right? How do we understand the options that are available so small businesses can find the best options for themselves?
Yeah. And to your point, I use a lot of buzzwords and I'm kind of in this bubble, right? You were making fun earlier of the fact that I'm speaking to you from our house, our tech startups house in San Francisco. It's very Silicon Valley. Yeah. But, and I use a lot of buzzwords and I apologize for that. But to kind of distill it down, the simple version is, before Wefunder, there's always been a number of different ways you can try to raise capital for your startup, right? But if you need to raise money for your startup or small business, Wefunder can be one interesting option for you to consider. It's still hard to get people to invest in you. It's hard to get your friends and family to invest in you, or your professional connections or your customers. It's hard to get them to invest in you, just as it's hard to get a millionaire to write you a large check. But it's an option you should take a look at it and consider it. And then the details of whether it's equity or debt or convertible note, blah, 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 can figure them out. But at a high level, definitely consider regulation crowdfunding a platform like Wefunder as an option there.
So let me ask you I have three questions that I'm thinking about as we're talking. The first is, my personal opinion is that a lot of fundraising comes down to sort of the tenacity of the business owner, right? It is not easy, whether you're going to a VC fund or your parents or your best friend's brother, and essentially putting your dreams on the line, putting your finances. It's a very vulnerable thing to raise money, I think, right? You've got to sort of put it all out there and get pretty good at rejection. What have you seen are the traits of the entrepreneurs who have been most successful raising money on your platform? What is it about them, not necessarily their businesses, but about them as entrepreneurs, them as business owners, that you think has made them successful?
Yeah, I mean, I think probably I will highlight, even though you just said not to, like the business is critical, right? That is probably the most important thing. So on Wefunder, if you have a business that's growing quickly, like where you can show like revenues growing, or like this is a profitable business and therefore investors are confident they're going to get paid back quickly, then I think that is the thing that ultimately makes fundraising the easiest. And that's actually an important answer to your question, because I think like however good the founder is at raising money, there are some times when it just doesn't make sense to raise the money. And however hard it is, obviously sometimes you need to raise the money, but like generally speaking, there are other things that you can do to grow the business and improve the business without raising money. And I think entrepreneurs tend to raising money too quickly. And oftentimes it makes sense to try to be scrappy, try to be lean, try to bootstrap it a little bit further, get a little bit more growth going. And then, once the business is in a better shape, then the fundraising is going to be easier. It's going to take less time, like less meetings to raise more money, et cetera, et cetera. So that's probably the first question. And then I would say to your question on like traits in the founder, I agree with you, tenacity. I think kind of willingness to put themselves out there. I think creativity, kind of related to tenacity, like hustle, like it's hard work, it takes time, like, it's like 9 p.m., you just put the kids to bed, you're really tired, I'm speaking from personal experience here. And then it's like, oh, well now, like, I got to go and write emails for 3 hours to like tell all my like buddies to go and check out my Wefunder page. That's like, it takes a lot of drive, and it's hard work to raise, even $100,000 on Wefunder, like let alone, $1 million. So I think kind of all of those attributes I would highlight.
Yeah, I think you said something that's really important. We say this to our businesses all the time, right? One of the things that I hear every small business that's struggling say is, oh, well, I need to raise some money. And I always say to them, right, like two things. Number one, the amount of work it takes to raise money, if you put all that energy into actually generating revenue, you'd probably find the money you need at no cost to you, and you'd actually build your business.
Yes,
and also,
100%.
if you feel like you really need money because you're in trouble, that's the worst time to raise money, because if you do raise money, most likely you're not going to be able to, but if you do, it's going to be at a terrible valuation, and you're going to get, rightfully so, the investors are going to want to protect themselves because this is not a good investment at that point. So,
My friend James Bashara came to speak. He's a founder. He came to speak at the Wefunder office, and he said something which struck me, because I was kind of having this debate with him, and I asked him, I have founders come to me all the time, and they say, well, the investors are telling me that I need to get growth going. But I'm saying, like, in order to get growth going, I need to raise capital to invest in marketing to get growth going. And so how do you break that cycle? And his response was, yeah, it's really hard. And you know what? The best founders figure it out. And so that's like, I think that I was like, oh yeah, I get it. Like, it is really hard. But yeah, you just got to figure it out. And I 100% agree with you. Like, if you can try to grow the business through revenue, you're not giving up ownership of the company. You're not paying a loan back with an interest rate. It's kind of a cheaper way to grow oftentimes.
Well, and it puts you in a position ideally too, where if you do that well enough and you ever do want to raise capital to inject the next stage of growth, all of a sudden your valuation's better. People want to invest because you've proven that your business works, right? It generates
Right.
revenue. People want to buy your product or your service.
Right.
Okay. Couple more questions before we wrap up. Practically speaking, what are the best business, like who's Wefunder perfect for? So if someone's listening saying, well, should I call them or should I not? If you could wave a magic wand and, craft your perfect, entrepreneur to use Wefunder, where are they at with their business? Who are they? Is there sort of a profile where you think what you guys do works best?
Yeah. So firstly, we help companies raise from $50,000. That's a minimum that we do, up to multiple $1 million. So if you're looking at raising 20K, like I would recommend something like Kiva, or like also like an Indiegogo.
Yep.
On the kind of perks-based crowdfunding side as like crowdfunding options. So 50K to $1 million. And then I would say businesses with fans that love them is the sweet spot. So usually pre-revenue or like pre-launch business. I mean, we certainly do kind of biotech companies, for example, that are, pre-launch and don't have customers yet. So this isn't a hard rule, but certainly if you're a consumer-facing business, and the sweet spot is you have customers that love you. And if you go to those customers and say, hey, we're raising capital to grow this business, you can be an owner of this business, then those customers are like, oh my goodness, I love your product, whether that's an ice cream or whether that's a mobile app. And so then they'll be like, oh yeah, well, this business is going places. I love the product. Other people are going to love the product too. So sure, I'll invest $1,000, which is the average investment on Wefunder. So that for me is the sweet spot. And obviously, the more customers love you, they really, really love you. What's your net promoter score? And also, the more customers there are. So if you have like 100,000 customers that think you're absolutely amazing, that's in the absolute sweet spot for Wefunder.
Perfect. And I feel like, again, I say this with all the love in my heart, but I often feel like many small businesses have very unrealistic expectations about, well, can you just introduce me to a VC, right? And they think they're going to walk away with $1 million check, right? We've alluded to this multiple times, right? Raising money is difficult. So you mentioned, the average investment size could be $1,000. So that's a small amount, right? You need a lot of $1,000 to reach your fundraising goal. And so,
yep.
Can you just talk to this business owner, right? Like, meaning this is going to be a lot of work, right? This, you don't sort of pop up something on Wefunder and instantly raise $1 million. So what,
right.
You guys are a platform, but what's the responsibility of the business owner? What's their role to actually try to raise that money?
These are really great questions, by the way. That you're really hitting the nail on the head.
Thank you.
You're welcome. It's almost like you work in this industry or something.
Yeah, it's almost like I talk about these things all the time. Yeah.
But so there's a spectrum, right? So Modern Times is a brewery in San Diego. They had 50,000 Facebook likes or something, a ton of customers, that people love the brand. They go on Wefunder, and a week later they have $1 million, right? Lost Spirits is a distillery in LA, same thing. One email to their customer base, they raise $1 million.
Isn't that great? Yeah. What a great day for those guys. How amazing.
Yeah, right. So but those are exceptions, right? To your point, usually it's hard work. And then also what you said, Wefunder is a platform, right? I would say we help to accelerate your fundraising.
Yep.
We do that in 3 important ways. Firstly, we allow you to raise money from unaccredited investors as well as accredited investors. So accredited investors are about 5% of the population. So now if you're raising money from unaccredited investors as well, now you can raise from 100% of the population. So a lot more people are legally able to invest in you. Secondly, you can publicly promote the offering. So normally you have to privately solicit, privately pitch rich people. With Wefunder, you can tweet about it, you can send an email blast to your customers, you can get on the local news, and anyone that sees it can invest. That's the second thing, the public promotion. And then the third thing is we have 600,000 investors on Wefunder, and we're going to put you in front of them. And as long as they think it's a good investment opportunity, and some of them will, almost always, then they're going to help you raise some money as well. on average, they're bringing about 40% of the raise. So we can help accelerate your fundraising in those three ways. But to your point, you know, if you just think, oh, we're going to put it up on Wefunder and then watch the 250K that we want roll in, that's not going to happen. So what I try to recommend is, imagine a world where Wefunder didn't exist.
Yep.
Okay, start to fundraise. What would you do? Okay, and so now you're like starting to have these conversations. You're trying to meet people that might write you a 10, 20K check and, you know, pitch them. Okay, now if you're starting to have some momentum and that's starting to go well, then great. Like Wefunder can help to accelerate that. But if you're coming to Wefunder and expecting or hoping that we can like do the whole thing for you, then that's probably not gonna work. And you know, if you need help in getting that fundraising momentum going, then that's where you know, you can help. Or there's a kind of plethora of resources and friends or connections or SPDC type organizations that can help you, or obviously resources online that can help you to try to think through how to get the ball rolling. But I think that's a helpful framework that Wefunder can accelerate and catalyze that, as opposed to creating a spark out of nothing.
Yeah, that's very helpful, actually. Okay, I think I said 3 more questions 2 questions ago, but I have 2 more questions, but they're quick.
Coming, I'm down.
All right.
I'm just apologize, but there's a garbage truck outside, so hopefully that's not.
And I think the sun might be rising right now too. That shows us how early it is right now.
Yeah.
Okay, so let's see if it's really 2 more questions left. So another question I have is, do the paperwork around fundraising can feel overwhelming. And I think a lot of small business owners wouldn't know what a K1 is, or they don't know how to do the compliance of a fundraise properly, and how do you actually issue shares. Is it accurate to say that if they were using Wefunder, that is administered for them, or how does that work, just from a compliance point of view?
Yeah, this is gonna be a little abrupt, or like this is a little extreme in what I'm about to say. Okay. Generally speaking, the founders that are raising money on Wefunder, like they kind of have a pretty good grasp of that stuff, I would say. And so if that stuff is like kind of really like you don't want to get into that, or like you're struggling to get into that, then I maybe would suggest like a platform like Kiva as like a smaller way to get started on crowdfunding, and then potentially building it up to like a Wefunder over time. Like there is a Form C that we file with the SEC. There's legal paperwork. There's contracts involved. Like it's because we're raising kind of 50K, 100K up. There's a little more, I guess, paperwork than something like Kiva, which is super, or Indiegogo, which is like super simple, super light, and so I think that's probably something helpful to keep in mind, just in terms of like the level of the stage and level of sophistication that's required to do something like Wefunder, which is higher than something like Kiva.
Yeah, I think that's very well said. I think that, it goes back to what we said earlier, right? It's not for everybody, right? So I think part of the game of being an entrepreneur is actually getting savvy enough to understand, what is the best option for you, and not just assuming that, because Mark Zuckerberg raised capital, that's what you have to do, right? Raise equity. So, just being confident that the right decision for you, your business, the stage of business you're in, the understanding you have, and not feeling like, there's one answer. Okay, this is really my last
Speak to advisors, right? Like speak to people. This is one like meta piece of advice I have for entrepreneurs, small business owners. It's the hardest job in the world, right? You're doing everything. You're the accountant, you're the marketing guy, you're the sales guy, you're the operations guy, you're the HR person, right? You're doing everything. It's so hard. And I think so often like small business owners kind of take it all on themselves. But and you don't even, there's people that you will know that have been through this and done this. There's resources that you can turn to. There's experts that you can consult on. on the fundraising strategy, on the, legal stuff, on the marketing stuff, on the website stuff. And so I think always as a small business owner, like, people love small business owners, right? Like, especially this COVID crisis, man, like, I'm going to be so sad. There's going to be restaurants that are not opening again. Like, there's an outpouring of support for small business owners, I think, right now. Like, please, like, just go and talk to people in your network that are experts on this stuff and can advise you on, like, what's the best capital raising strategy for you. And if you don't have that person in your network, then go and get them in your network and spend time, rather than try to figure it out yourself, spend that time trying to go and find an expert who can then help you with it. So I think too often entrepreneurs try to do everything themselves.
Well, and I think that there's too, I think you're exactly right, because I think that there's this inherent shame where it's like, well, or an embarrassment. Well, if I don't know about all these things and I admit that, then no one will ever invest in me. But I remember one of my advisors said to me, Krissa, if you want money, ask for advice. If you want advice, ask for money. Because, people who are going to write a check actually respect that you're asking for advice and you don't think you know everything and you're looking for the information that they know that you don't know, right? But that's actually, that is a quality.
Right. And also, after you talk to the expert and have them, like, coach you on whatever issue it is, like K1s, for example, in that example you gave earlier, then you will know that stuff, right?
Totally. Okay, last question. Is there a book you recommend? If there was sort of like, if someone wanted to learn what they needed to know about raising capital or understanding, the landscape, just that small topic. Is there any source that you just think is the one that you like the most or that you think is a good place to go?
That's a good question. I honestly can't think of a book. I'm going to say a really weird thing. This is a weird book recommendation.
I'm interested.
I read through our FAQs on the Wefunder page the other day, and they're really good. So these are more geared towards, like, Wefunder and, like, investment crowdfunding. But on that topic specifically, the FAQs on Wefunder, I think, are the language that our CEO wrote them, and the language it uses is excellent, very helpful. And so if you want to learn about equity crowdfunding, then go to the Wefunder website.
That's actually great, I think. That's helpful.
It's a weird book recommendation.
No, but I think that that's so practical, because I think sometimes this conversation can become so heady and so, unpractical, honestly. And I think probably that's actually probably the most accurate recommendation, which is, here's questions that get asked and here's the answer. So I think that's probably actually a very good answer, Jonny. I approve.
Yes.
Okay, so Wefunder the website is just
Wefunder.com. Wefunder.
Okay, and we'll make sure that that's written across the bottom. We'll make sure that small businesses have access for how to work with you. And if they want to get in touch with someone at Wefunder, or they want to explore if this is really right for them, after they read the FAQs, after they've thought strategically, not, just, going for it, what's the best way to get a hold of you guys? Do they reach out? Is there a form on the website? How do they?
Yeah, you can email hello@wefunder.com, but I'm also Jonny@wefunder.com, JONNY @wefunder.com.
Awesome. Thank you for that. Okay, my friend, thank you for this. I actually thought this was interesting. I had a fun time.
You sound surprised in saying that in a way that is undermining of my self-confidence.
Well, in fairness, we're talking about equity fundraising. I mean, there could be more exciting topics. There could be.
That's true. We had a securities lawyer on our podcast the other day. Adventure Capital is the podcast, and is like securities law, right? Like, there couldn't really be much more of a boring topic than that. But she was awesome. She was, like, super funny and fun, and so I called the title of the podcast episode was "Sexing Up Securities Law." Hopefully I sexed up equity crowdfunding this morning.
You've done a fabulous job, Jonny. Thank you for that.
Thank you. This was fun.
All right. Thanks so much.